Hello and welcome to my channel. My name's Charles Delastic. I'm the Managing Director of Bluebond Tax Planning. I've been an inheritance tax specialist for more than 18 years and helped hundreds of clients with their estate and inheritance tax planning. So one of the things I've learned is that if people make mistakes on their inheritance tax planning, it can be extremely expensive if the plans are not properly set out. Now, obviously, you need to understand what you're doing and to make a decision as to what to do. And people quite often, because they can't be bothered to take on the complexity of the different possibilities, just go for a simple solution. And really, all decisions like that have consequences. Even the decision to do nothing, which is obviously the most simple solution, will have the obvious impact of a large amount of tax being payable. So a proper inheritance tax plan can be complex, and it does require comprehensive solutions if people are trying to meet a wide range of objectives. So what are the various strategies you can use? And that's what we're going to go into in this video. Welcome back. So the first strategy is obviously understanding your allowances, and you've got some various free allowances that you can use. So if you're single or divorced, you can have an allowance of up to 500,000 if you own a property. So 325,000 a normal allowance nil rate band, and a residential nil rate band of 175,000 at this time of shooting. Now that's supposed to go up by consumer price index, which can be anything 0.5% to 1% a year. If you're a married couple, obviously you get double those allowances, so that's up to 1 million. But interestingly, if you're a couple where one person has been widowed before, then effectively you can have an allowance of up to 1.5 million. But that requires some careful use of trusts and planning your wills, etc. So there are various ways that you can keep the value of your estate down, and we'll go into those. Right, so strategy number one is very simply spend your money. Well, you made your money, you can enjoy it and just simply decide to spend it. So if you keep your estate below the taxable allowance and you spend everything else, that means, of course, there won't be inheritance tax to pay, but it will have the consequence of having less money available for your family. So the simple solution is to spend the money. Another relatively simple solution is giving your money away. Now, if you do this properly, it can ensure that more of your wealth is passed on. Again, you've got to watch our video on, when I say properly, on is estate planning more important than inheritance tax planning? Because there are all sorts of consequences to giving your money away, and most of them are unintended. So for example, you may need money for care in the long term. Now, care costs can be anything £50,000 a year, and that can eat into an estate fairly quickly, really. But if you need it, you need it, and by giving all the money away and then your children having spent the money, doesn't leave you that possibility. Again, there's tax issues, especially if giving properties away, for instance. Capital gains tax is realised, so there are problems around the tax. It may even create tax problems for your children. Another issue is that if you've given your money to your children and they get divorced, it's not just your children, your grandchildren, because if you put money to trusts instead, trusts last 120 years and can protect the money. But as I say, the video I was talking about, is estate planning more important than inheritance tax planning, is really worth watching if you don't understand that particular scenario. Very simply, it talks about why gifting money is not properly protected. But that's a simple strategy as well. So another relatively simple strategy, which actually doesn't avoid inheritance tax but pays it, is putting life insurance into place. Now, almost any advisor will understand this and enable that to be put into place. But interestingly, there are again different ways of doing this, and once again, I've got a video which talks about how you can save money by utilizing 2 life insurance policies rather than 1. And that really talks to deciding what you're going to keep and putting in 1 insurance plan for that for the long term, because you're going to keep it, for instance, your main residence and things like that. And then you can also decide what assets you're going to give away. But most people are aware there's a 7-year rule there. So, and it may take you longer than 7 years because of capital gains tax. Therefore, you might want to put a second policy into place to just cover the assets temporarily while you're in the process of dealing with your inheritance tax plan. So that's a video worth watching of how you can save money using 2 life insurance policies rather than 1. Again, there are potential consequences to putting life insurance. It can be expensive if you've got health issues. Sometimes you may not even be able to get cover. It can be complicated to work out the correct level of cover, because obviously inheritance tax is not payable today. It's payable when the second spouse dies, and therefore you've got to project the value of properties and other assets over time to make sure that you've got the right level of cover. And last but not least, if you're spending money on insurance policies, then obviously you've got less money to spend yourself and less access to capital, and that may have an impact as well, which needs to be explored. But again, a relatively simple solution that does work. Another solution which, if put in by itself, can be relatively straightforward, which is trusts, but most of the time it's relatively complex because there are different types of trusts to use, and the different ways that they interact should be understood before one goes into trust. And the tax implications of trusts are also relatively complex as to how they impact upon the people putting the money into the trust and the people receiving the money from the trust. So you should always get good advice on setting up trusts before you do so. Again, because of the different types of trusts and which is the best ones. Have a look again at a video that we've produced there, which is called How to Use a Flexible Trust to Avoid Inheritance Tax. So if the subject of trust is interesting, watch that video. Okay, so that's another solution, number 4. So strategy number 5, which is actually relatively complicated even in of itself. Now this suits people with large estates where the total value of their assets is well over 2 million. But it can be useful, particularly if you own a property portfolio, in saving capital gains tax. So you can watch our video on using family investment companies to avoid inheritance tax, and that, that'll give you more idea on how that particular topic works. But basically they are challenging because the setup itself is complicated. Tax rules may change in the future, which may negatively impact the way that these plans are done. So for instance, we know that landlords are subject to a specific tax called Section 24 about 5 years ago, and HMRC produced that tax specifically for landlords and nobody else. So does it mean that they can produce a specific tax for companies which own mainly property? Yeah, the answer is they could. So one shouldn't depend upon this scenario only, but it certainly is very effective for avoiding inheritance tax. Also, if you do it with something called an employee benefit trust, it can save huge amounts of capital gains tax. Another consequence of them is that they cost money to maintain, right? Because you have to pay an accountant to produce the tax returns for HMRC every year as well. So again, a more complicated solution, but it does have consequences, but something that does work. So here we get to the crux of it. Really, I would ask you the question, what are you trying to achieve? So if you want to protect your assets for your family bloodline, in other words, your children or grandchildren get divorced, how do you ensure that they keep the money that you give them? Do you just want to save inheritance tax, or do you actually want to save income tax, capital gains tax, stamp duty, land tax? How flexible does your plan need to be going forward over the next 15 or 20 years? And how do you make sure that your own standard of living is maintained almost no matter what happens? So what happens if you go into care? How do you put the assets outside of your estate while still retaining access to them? So again, that's quite important. If you want to achieve all of those points, then really you've got to weigh up what you do and invest some time into understanding the more comprehensive solutions that are available to you. Any plan is better than no plan. I'm not saying it isn't, but simple plans are not as effective as much more comprehensive plans. That's the point I'm trying to make. So simple plans like life insurance or placing an investment bond into trust are relatively easy to understand. They are effective to some degree. But let's give you an analogy. If you wanted to lose some weight because you were going on holiday and wanted to look better on the beach, yeah, sure. A simple diet might do the job for you over a space of a couple of months and you would lose some weight. That would also have a positive impact upon your health. But if you actually wanted to improve your longevity in life, you wanted to improve your overall vitality, then what would you do? Well, simply losing a few pounds isn't going to cut it. You've really got to look at an integrated nutrition plan across the board. You've got to look at a strong exercise plan that works for you, and probably I would say training rather than just exercise. You've got to be looking at your sleep and how you improve that dramatically. How do you reduce negative stress in your life? How do you improve your positive relationships? All of those 5 or 6 things coming together will help you to produce a much more comprehensive solution if that's what you want. So, as I say, simply trying to lose weight is one thing, and it will certainly help towards longevity and vitality, but it's nowhere near as effective as a plan that encompasses nutrition, exercise, sleep, low stress and positive relationships. And therefore, if you're going to put a plan like that together for your health, you've got to understand you've got to take on more complexity and try and put these things together. But the comprehensive plan is much more effective to meet a long-term goal. And it's actually the same for inheritance tax and estate planning. So in this video, we've discussed simply some simple ways of avoiding inheritance tax. But as I say, 1 or 2 simple solutions do work, but they're not effective for producing and hitting a wide range of objectives. So as a firm, we always recommend more effective overall solutions, and that's a comprehensive plan. We believe that clients should understand all the solutions that are available to them and make recommendations as to a mix of those different solutions and how they best suit that particular client. So it's a tailor-made plan for each person. Really the key is to understanding the different parts, and then if you choose to not go forward with some aspects of it because that particular benefit isn't a big thing for you, sure, it's a benefit, but it's not big for you. You could choose to not move some part of the plan forward, but at least you'll understand what you're not doing and why you're not doing it, as opposed to just starting in on a very simple plan because it just is easier to deal with. So I would say you need to spend, if you want good results, you've got to spend some time, you've got to spend some effort understanding recommendations for you across a wide range of solutions, and then make the decisions that are right for you from that understanding. I hope all of that helps. Thanks for watching. If you enjoyed this video, please give us a like, and I look forward to talking to you in the next video. Thanks, and bye for now.